Let's be honest, folks. The big knock on the 2023 bull market so far has been that it rests mostly on half a dozen companies that are thriving mostly on AI hype. Whether it be Apple hitting a fresh new $3 trillion market cap or Nvidia being up more than 100% over the past 12 months, there's no doubt that large cap tech stocks have outperformed broader indices by a pretty significant margin. And this has resulted in a bear thesis around small caps having lagged the rally, resulting in potential underlying downside for the rest of markets. However, folks, just over the past week, we have seen recent developments from inflation data to the performances of various industries like transports, real estate, and energy that show us this market rally is actually starting to broaden. And that is extremely bullish. A $6 trillion market rally in markets is not what Wall Street predicted for 2023. Most analysts over the past 12 months have been completely wrong and did not expect this face ripper of a rally that we have experienced so far. And it turns out that same contrary indicator could be used for small cap growth stocks, which happen to be in that same shadow right now. And why exactly do I believe that? Well, there's two main reasons. The first being the fact that economic surprises from GDP data to jobs reports to the PCE inflation report have come in higher than expected for the sixth consecutive time. Yes, you heard that right, folks. For the sixth consecutive time, we are seeing beats in what most analysts had expected. And as we all know, stocks mostly run around analyst expectations and earnings expectations. And if earnings start to get revised to the upside, then there's a lot of strength still left in the tank for this current rally. And although given the massive gains we've seen in large cap tech stocks, they might not be the ones leading that rally, small caps, as seen by the equal weighted index, certainly could. As you can see, a ratio of the equal weighted index to the actual S&P 500 is at all-time lows over the past 18 months. The correlation is sitting at around 1.3, which we sincerely have not seen since this crash of 2020. If you ask me, that is an opportunity because as you can see throughout 2022, when interest rate hikes were shocking markets, this correlation was actually sitting around 1.5. That means if valuations stay the exact same and we simply see a mean reversion in the assets of small and mid caps, which are typically any companies underneath a $50 billion market cap and tends to be those companies that are unprofitable and very early stage, we could see some significant upside. And guess what, folks? The recession that many people have predicted for the 6 months starting 2023 has simply not materialized. Instead, chances are we're currently in the midst of a rolling recession, which is essentially when you are seeing layoffs in the economy, but they are typically restricted to one sector, this time mostly being tech. If you look at travel, leisure, or even real estate, those aspects are holding up extremely well, and those companies are actually hiring right now instead of laying people off. And yes, although the S&P 500 makes us believe that the tech sector is the most important economic indicator, in reality, it simply isn't. Because just last week, we got the GDP print for the first quarter of 2023, and as you can see, it came in way above expectations at 2% growth. This is nowhere near a recessionary situation, which means markets have more upside as earnings expectations can start to revise, particularly for those industrial and non-discretionary stocks. And as we all know, in the long term, as the bull market evolves, it brings along all the different industries together. And whether you're invested in electric vehicles, clean energy, or even food and leisure, you are going to see some gains if this bull market continues to the upside. And rest assured, with the way that most retail and institutional investors are positioned, chances are the short squeeze could be amplified in this new rally. As you can see, total money market fund inflows have actually been negative for the first few months of 2023, and were negative in the latter half of June. Whether or not this is a sign of what's yet to come is a different question. However, this has always been a contrarian indicator of how generally markets could perform. Because as we all know, the real movements of stocks is done by algorithms which themselves are run on economic indicators. And as of last week, those economic indicators have been quite strong. Not only did the Fed's general business outlook indicator come in positive last week, but we saw inflation and retail sales data beat and throw most analysts' expectations completely out of the water. As you can see, the personal consumption expenditure index, which is what the Fed uses, fell to 3.85%, the lowest level since April of 2021. It's pretty clear that anybody who is predicting inflation to be a stagflationary event or continuing to increase over the next few years has no idea how the economic machine works. Just because you're paying a little bit extra for eggs or groceries today doesn't mean that actual inflation isn't falling, because as we all know, there is a major lag between when consumers experience inflation and when the indices experience it. And although core PCE inflation, which is ideally more sticky right now, has been ticking slightly steady, it is still in a downtrend on a month-over-month basis since the start of 2021. And I would argue that this right here is one of the reasons we are seeing so much strength in the stock market. Because core PCE inflation remaining sticky means that the underlying economy or the white-collar workforce is not getting laid off as aggressively, and business is still very strong. If this index starts to crash over the next few months, that could actually result in a downturn in equities, because it could be seen as a risk-off move as economic conditions change. And so, believe it or not, core PCE remaining sticky, in my opinion, is a good thing. And as you can see, this broader strength in economic conditions is exactly why something like the VIX volatility index has collapsed since the start of this year, even though we have seen some developments from Russia, SVB, and the crypto markets about potential financial instability. At the end of the day, this VIX index is not a predictor of what markets are going to do, nor is it a contrarian indicator. The VIX is simply an indicator of options volatility. It is a percentage change in implied volatility for options contracts on the S&P 500 index, which means this is driven a lot by short-term trading. And as you can see, folks, even though many people were expecting the VIX to skyrocket to the same levels that we saw during the pandemic of 72 to 80, we never saw that happen when the market bottomed in October of last year. It goes to show you cannot base your investing decisions off a single indicator, because markets are designed to fool 99% of investors. Instead, this kind of decline is actually a good sign, because it means that general instability in financial markets is not growing apart from the general economy. And as you can see, the VIX was sideways throughout 2018 all the way to the start of 2020. And the bull market of 2019 was one of the best we've seen in the past couple of decades. Now, certainly don't get me wrong. This doesn't mean you should go all into any positions that you have or forgo fundamentals. You should still do your research and pick the right businesses, or simply invest in index tracking ETFs, because right now volatility is actually quite high, as seen by the national open interest, meaning people are betting a lot on call options. And that is resulting in cross-asset volatility declining sharply over the past couple of months. This means you have to be even more picky with the positions you choose, and you can certainly get burnt even if markets continue to rally. So, what do you guys think? Is the small cap rally going to extend itself in the end of the year, or are we going to see continued underperformance from our favorite growth stocks? As usual, folks, let me know your thoughts down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.